Let's have a look at tax. Some of you may already have part-time jobs and are used to paying tax. And particularly on certain weeks where you work lots of hours, you notice that you do get taxed. I wonder if you've ever thought about what taxes go to pay for. So first of all, tax, when you make a profit from something, so for example, your wage, your pay, you're earning money, but also if you have some investments like a savings account, you can get taxed on that too. So tax is collected by the government to fund public services and initiatives. Things like, so for the public system, hospitals and schools. They also fund private schools as well. Electricity and water, not just the cost of the water, because obviously we pay our own electricity and water bills, but the infrastructure that's involved to put that in place. Buildings, roads, transport services, and other infrastructure like that. So as a community, as a civilization, we commit to paying tax so that we can live better lives together. For this video, we're just going to look at investment success here. So if you've got some savings account and you've got some interest that you've earned from that and the tax that you have to pay on that. And so that affects what's called your after-tax return. So you don't get all of that interest back because you'd have to pay some tax on it. So here's a tax table. So the amount of tax that you need to pay depends on how much you earn throughout the whole financial year. It's on page 75 of the South Australian textbook in this particular year, 2023. So let's have a think about that. If this is called the tax-free threshold here. So if you earn under $18,200 in a financial year, which most of you as young people, perhaps in year 11, would be doing, you actually at the end of the financial year don't have to pay any tax. So you might ask yourself, well, why is it that on certain weeks when I worked a lot, I had to pay tax? This is just a side piece of information that's not to do with the video, so to speak, but what the tax department's trying to do is think, oh, well, if you work that many hours every week and, you multiply that by 52 weeks in a year, then actually at the end of the financial year, you'd probably be in the next bracket up, which means you would have to pay tax. So we're going to take out 19%, which is 19 cents in every dollar that you earn, and take that aside. So at the end of the financial year, we've taken away enough tax. But what usually happens for young people is that you don't end up doing that many hours every week, maybe more in the school holidays or on weekends and that sort of thing. And so by the end of the year, you've actually earned less than the 18,000, which means you should have paid no tax. So you get it back from the tax department, provided that you do your tax return. So there's just a bit of a side note about why you are taxed some weeks, even though you shouldn't have to be, because they're trying to predict that what would happen if you earned that much every week. So that's the tax table that we're going to use. The steps involved for this is we're going to look at the total income, so how much you earn from your wage, and then how much from any interest. Determine which tax rate you need to pay, so which of those rows in that table that you fit into, based on that table. Find out how much tax you need to pay, and then which is calculated by looking at that tax rate as a percentage multiplied by how much you earned, and then to work out how much you get back, you look at, well, how much interest did I earn, subtract off how much tax I need to pay, and that's how much you get to take home, so to speak. Let's do a question. Derek has a salary of $72,500 and he receives $1,740 in interest from a savings account. How much tax must Derek pay on the interest? So what's his total income for the whole year? Therefore, it's not just this 72, we have to add these two numbers together because it might mean he goes into a different tax bracket. It pushes him over the threshold for one of them. So we add these two numbers together. So 72500, adding on the interest, and we get an answer of 74,240. Which bracket does he fall into? This middle one here. It hasn't pushed him over the $80,000. So how much tax does he need to pay on that interest then? We do that as a percentage. So it's 32.5% of the interest amount, because we're just actually working the tax on the interest part, which is the 1740. Just a side note, remembering that this number here is 32.5 over 100, which comes out to be 0.325. And of is a multiply. And so the amount of tax he has to pay then is $500 $65.50 with a dollar symbol, of course. That's a zero there. And then the next part of this question is his after-tax return on the investment, which means he earned $1,740 in that interest, but he doesn't get to keep it all. He has to pay some in tax, which was that $565 amount. So we subtract the two. So his his interest was this amount, subtracting off how much he paid in tax. And what we're left with there is $1,174.50. So that's his after-tax return on the investment. These questions can be a bit wordy, but they're the steps involved. Just a note there that you will need the table, that tax table, to be able to do these questions. Give this video a like and subscribe to the channel. Thank you.